All right, everybody. Welcome back to episode 49 of the More Doors podcast. We are back. The three amigos are back together. We got some details coming about that, and we have an amazing guest. We'll be right back with everybody right after this. All right, everybody. Welcome back. Today is episode 49 of the More Doors podcast. Finally, a number episode older than me. Actually, it's a couple now. First time I realized it, though.
Yeah.
Nice.
That's fair.
We are back. The three amigos are back together for the first time. Brian Force is back. He was riding Orcas off Juneau, Alaska for a short period of time. Did you tell the audience about what it was like to ride Shamu?
You know what's crazy is, so like, you're joking, but we were whale watching and they get really close to the boat. Really close.
Yeah.
And there was a small part of me that was like, I wonder what it would be like.
Just jump on that thing and say, ride
you get
cowboy.
In a lot of trouble, I'm sure, but you can say you did it. They're so big. It's ridiculous.
If you lived through it, just to say you did it.
Yeah, I don't think they're super friendly if you jump in after them.
Aren't they like, it's like mammal on mammal. That stuff doesn't happen.
If I jumped on your back, if I jumped on your back, would you be happy about it?
No.
I don't think.
There's an agreement.
You're bigger than him.
Yeah,
so if he jumped on your back, would you be bothered by it?
I mean, it'd be annoying.
Yeah.
Yes.
And you could kill him in an instant with your fangs or whatever they have. I don't know if they have fangs.
Big teeth.
Their mouths are big enough it would swallow your entire family whole.
Really?
Bro, if you ever seen them up close, they're like 200 feet long. It might be an exaggeration,
Just
but
a
they
little.
seem that big. They're
Moby
massive.
Dick.
They're
Yeah.
so big.
Those are blue whales, not orcas.
Yeah.
Killer whales are a little different.
No, we saw humpbacks. They're really big.
Oh, humpbacks are big.
Are we going to start a whale podcast next?
We are. We are. We're going
All
to do an oceanography podcast. It's going to be great. It's going to be like Shark Week.
I did do an oceanography class at UTD.
I did one.
How do you have an oceanography class in Texas where there's like no ocean?
We get stuff shipped in.
It's about being well versed and cultured.
Yeah.
I can't tell you. I passed the class. I couldn't tell you what it was about, though.
Yeah.
Okay, cool.
The ocean.
It's where our tax dollars are going.
See? How many oceans are there in the world, Nick?
A lot.
Shit.
We don't need to know.
Four.
No, we don't need to know those answers. We have ChatGPT right here.
Oh boy, I know all about ChatGPT.
Yes.
All right, enough of the BSing. Good to be back. Good to have the team back. We have an amazing guest. Before we get into the show, Nick,
sponsors.
you want to take us through our sponsors?
Yes. You do such a great job on sponsors, but I'll go ahead and take it today.
Go ahead.
Because you know who doesn't BS around? That's Deep Blue Capital. Those guys are serious as all get out. And they throw great parties. They mastermind yesterday on throwing the best investor parties that anybody has ever seen. So if you're interested in at least getting on that invite list, then you need to go to deepbluere.com, sign up for that investor portal there, and you're going to get on the investor newsletter as well as the book that Brian spent years writing, years writing that book. And then you can also see what projects we're investing in here at Deep Blue Capital. I know that we've got a call with our storage team later this afternoon. So we've got storage investments, we've got multifamily investments, we got something for you. So go to deepbluere.com. And then our guest was interested in learning more about how he could have his own podcast. And so we said, you know what, that's great news because we can tell you, just go to torestudios.com, TORE studios.com. Jesse, the man behind the camera, but in front of the microphone, he will take care of you. So he's going to make you look good, sound good, feel good. He'll give you all the goods.
All the goods.
torestudios.com.
.com, We are excited to dive right in I'm excited about this guest. I'm not going to give his background for him. I never do that with guests because I always like to hear it from the horse's mouth, but let's welcome him, Mr. Mustafa Ladha. Welcome to the show, brother. Thank you for taking the time.
Hey guys, thanks for having me. It's the first time I've been called a horse, but I do appreciate the introduction.
Man,
I can tell, Deep Blue Capital, you guys are interested in the sea, making money, and all types of animals.
Yep.
So
Yeah.
Brian's
I'm definitely with you on the making money. The rest of it, I'm here to learn.
We should talk about doing an investment in a racing horse. Is that I heard there's money in that?
Yes, I will tell you. I have friends that have invested in racehorses. Their return on their capital has been absolutely amazing.
Really,
we're gonna partner on this.
So we'll talk about it because my head of finance, he owns a horse, like one of those fractional shares. I think his horse won the Kentucky Derby and then was retired. I don't think he made money though. So they won he won the biggest race possible. And maybe I'm wrong. Maybe he didn't make money, but
but not
it didn't sound like that was what he was bragging about. More the victory than the money. So
well, at least you could probably get tickets if you own the horse. We could go to the Kentucky Derby. That'd be a way to do that.
Yeah, but it's probably cheaper just to buy tickets for the Kentucky Derby than buying into the horse.
Then you can't walk around and say that you own a horse.
True.
Kentucky Derby. You're just a peasant.
But I think Mustafa's friend he bought the parts of the fractional horse where he has to help stud him out.
No. I think he does the accounting. That's his head. He's CFO, right? So his head is more, finance, accounting.
Right.
That's Mustafa. That's why he wasn't bragging about it. That's not the fractional that I'm buying into.
That's hysterical.
I know, because you have those 4 kids you were talking about. Your fractions are different.
Well,
this is going to be a good show.
Yeah. Speaking of 4 kids, tell us about yourself. Tell us about what where you're investing in, and give us. We need to become stalkers of Mustafa. So tell us about you.
Sure. So more than happy to. I have 2 kids, 1.5 and 4. I think keeps changing. Other than that, I invest in multifamily real estate, a lot of ground up construction, decent amount of value add, a lot in the Northeast, primarily 30 to 45 minutes from New York City in opportunity zones. But the Mustafa you see here in front of you on podcasts is obviously like one that's been just learning and growing throughout my career. I went to Rutgers, studied genetics, went to medical school, decided that wasn't really the path for me. Then joined Big Pharma, worked at a couple different companies, really built out a couple of different side businesses, but treating them as like, hey, what is the most efficient path to scaling? And I don't know, I don't want to speak for you guys, but I'm sure it's something that you think about often. And that ultimately led me to scaling in real estate, to getting involved in syndicating real estate, getting involved in co-GP type structures, raising capital, helping people learn how their money works, helping people make money, and just being as efficient as possible.
100%. It's funny that you say that, and I want to dive way deeper on a lot of different aspects of what you just talked about, but this just kind of sparked my mind. Is we talked about this exact same thing yesterday about where is our time best spent, and I think you've probably put a lot of energy and focus and thought into as well. And in the multifamily, especially the syndication business, it can seem very complex, and it's definitely more complex than running a snow cone stand, probably. But we have a belief around here that it also is simpler than people make it out to be, especially people that have never really been a sponsor or a GP before. We really break this business down to kind of 3 pillars. It's finance. So how do you raise money or provide opportunity for people and get them in on your deals? Deal flow and underwriting, getting deals and opportunities for the people that you're raising money from, and then operations, asset management, those types of things. And in each one of those pillars, there are systems and processes in place to keep each of them running at an optimal level. And the conversation that we tend to have on a regular basis is, what are the parts of each one of these pillars that we are the best people to be doing and spending our time on? And what are the best parts to be leveraging and trading essentially, our own capital for a result? Are we the best people to be running our own social media and digital marketing aspect of the getting new investors in the door, of the raising capital? Probably not. We now have outsourced that. It wasn't always that way, but through a lot of our conversations, that was a decision that we've made. And when you start to break it down like that, you tend to really realize that the things that you're best at are the things that when you focus solely on, your business can really start to scale. You're usually holding yourself back if you're trying to do everything. And I think, I'd certainly love to hear your journey as far as like that aspect of discovering where your time was best spent on your business and how it helped you scale.
No, I love it. I love it because it's very relevant to something that a lot of us don't realize that we need to focus on more. Like, when you're in school, it's very easy. You get a grade, you kind of know where you stand. But in entrepreneurship, no one is giving you that immediate feedback, so to speak. And sometimes your strategy is long term, so you have to give it time to see it pay fruition, if that makes sense. And I think you guys kind of alluded to it on one of the earlier conversations where you're talking about taking little steps to scale, being comfortable being uncomfortable. And I think that's really important from a growth perspective. But the way you started out the question was really about scaling and how do you figure out the most efficient way to scale. And I think, honestly, in my opinion, it's really a journey of self-discovery, to the extent that you want to focus time on tasks you're good at, but you don't know what you don't know. So initially, you need to figure out what you're good at. Then you need to figure out what you're better than other people at, which could be different. Then you want to figure out to some degree what gives you energy and what drives your passion, what kind of motivates you versus what tasks demotivate you or are draining. Like you mentioned, like the social media marketing piece, for example. Something I do, capital on WhatsApp. I've raised over 30 million on WhatsApp. Raised capital on LinkedIn. Started that maybe 7 months ago. Raised over $1 million on LinkedIn. And for me, like, creating content every day is not fun, to be honest with you. But talking to people like organically, like the kind of conversation we're having, I love it. I'm more than happy to. So it's kind of one of those things that you want to spend your time on activities that you enjoy, that drive the needle forward in terms of generating revenue or creating value. And I separate them as two different things because, to some degree, a lot of times it's all about, money and more transactional mentality. And I think that that's very short term. And as a person, as an individual, I like to build like long-term relationships rather than short-term transactions. So it just really becomes, how can I create as much value as possible for people? And we'll figure out that monetization strategy later. Like if you treat yourself like Facebook or Tesla or Amazon or any big company that's generating a lot of revenue, profit, bottom line today, they weren't always profitable. And that's kind of your journey in America. You go to college, you go to elementary school, whatever, all that stuff. You go to college, you're investing in yourself, you're putting money in. Then you get your, day job, you're making your 20 to 400K, whatever, wherever you are in life. And then people kind of stop learning there, typically. At some point, they plateau. Maybe it's when they have their fourth kid and they have no more time to breathe. Maybe it's, when they get out of college and it's just the anxiety of applying for jobs. Whatever it is, at some point, people kind of plateau. And it starts by not investing in yourself. And I feel like this is probably a common trend in our space. It's really just continue to invest in yourself and scale. And the things that I would add is you optimize to learn and grow rather than optimizing for salary. And you kind of always need to be asking yourself tough questions and putting yourself in uncomfortable positions to then continue to grow, if that makes sense.
Yeah. Let me jump in for a second.
Please.
So, Mustafa, I want to double tap into what you just said. So you were in pharmaceutical sales. You go to school for genetics. You were in pharmaceutical sales for 7 years?
No, I was in drug development. Even less fun, less, attractive. I was like the guy underwriting.
I mean, you're in New Jersey, so I think there's a lot of pharmaceutical salespeople out there.
Yeah. No, I'm saying because pharmaceutical sales is more lucrative.
Yeah,
and, revenue generation is better than cost savings in terms of like what businesses typically value. If that makes sense.
So you're in pharmacy, you're in drug development for 7 years, and you pivot and you go into real estate. So talking on the topic of self-education, how did you go about educating yourself to, number one, know that real estate was for you, and then kind of the continuing education from there?
So there's like the nice marketing answer, and then there's the truth. So I'll just give you the truth, if that's okay.
Appreciate it.
Yeah. So I come from an entrepreneurial background, entrepreneurial family. My family, my dad was born in Tanzania, moved to the US, probably in his, let's say, early 30s. So very business oriented, very business mindset, very entrepreneurial mindset. That kind of made it easy to pivot because all my life I've been around, business people. But I think when we talk about the things we talk about, it's hard to value what you view as normal. So, I was in medical school, decided it wasn't for me, came back working in the pharmaceutical industry, realizing, hey, I'm not making enough money for things to make sense and for me to accomplish like my goals in life. So I'm like, okay, how do I figure out how to make money? Entrepreneurship. I worked in my family office in the past. I'd done other things in the past to make money. So I'm going to kind of figure it out on my own. That was my mentality. And so that's what I invested time in, just personal finance, personal literacy, just trying different business ventures. I launched an e-commerce company. I had different types of real estate businesses that I tested out. And then ultimately I was having a conversation with one of my uncles, and I just said, like, listen, like, what is your biggest problem? And this kind of starts maybe a trend of like my most successful strategy. And if I could patent it, maybe I would. Of just going to people, mentors, people 1 to 2 to 50 steps ahead of you, and just asking them what their biggest problem is. Because for you, that's an opportunity to add value. By adding value, you can figure out a way to monetize later. So for him, for us as a family, we managed a private real estate investment firm that managed our own family capital, our own network of ultra high net worth individuals. And it was really, hey, if we had more capital, we could do more deals. I'm like, okay, that's fine. Who do I know? Then the next question is to myself, who do I know that they don't know? I know people who don't have money per se. So how do we create a structure, and how do we scale down more to a crowdfunding Reg A type platform? So I build out a strategy, budget, etc. And I say, hey, listen, if you give me 500K, I'll build out this online real estate crowdfunding platform. And this is in like 2018, while I have a pharmaceutical job and I'm doing other things as well.
Wow.
So this is like me at the age of like 24, 25 saying, hey, give me $500,000. I'll build out this platform. We'll raise, we'll ramp up to raising 50 million a year in this strategy. And then the family response was, hey, the opportunity cost doesn't make sense. Basically, it's not worth the 500K to spend on a platform to raise capital. It's better to put that 500K into real estate. So that's very fine. It's a valid perspective. And I'm not in a position to refute or agree with that. I'm just able to say, okay, no problem. That's your perspective. Sure. So let me build an MVP, a minimum viable product. Let me scale this down as much as possible to spend as little money and see how much we can raise. So come back with a new proposal, 75K a year. Okay. Over the next, let's say, 6 years or so, I spent maybe a cumulative like $3,000 to $7,000 max, raised over 30 million, and it was all on WhatsApp. To basically say that you don't necessarily need to spend money to make money. You don't need to spend money to raise money. But like we discussed earlier, that doesn't mean it's the most efficient way. And as you learn by doing, you can implement different strategies to scale more efficiently, like the digital marketing that you guys alluded to earlier. You can do it yourself and you guys can be experts in it. But is it the best use of your time? Because time is that commodity that you're not going to get back. So at a certain point, when you can afford to spend on a digital marketer, then that's better than you doing it yourself, because you want to spend money on those activities that, create more value or make you more money, if that makes sense.
No, 100%. And there's something that sometimes in certain episodes we go down the path on. I'm forgetting who was the gentleman that who was in tech sales and then he went back into, was it Ryan? Is that his name?
To know?
Yeah. Yes.
Yeah.
Yep. And so he kind of went down his path of raising money, and you've said it twice now, of raising $30 million off of WhatsApp. And when this business, number one, is about finding opportunity, but then the second part is you have to have the capital in order to execute on the opportunity, right? So tell us, how do you raise 30 million off of WhatsApp? Is this people that you knew? Is this connections? Like, walk us through that strategy and that playbook. Oh, you're muted.
Oh.
Uh-oh.
Yeah, can you guys hear me?
Yep, there you are. You're
Sorry.
back. So tell us the strategy and playbook there, and we can cut that out.
Sure. So very simply, I think it starts at a fundamental level by saying, things don't happen overnight. We're in this era of immediate gratification. We're in this area where, people are kind of advertising themselves as the final product, as, hey, like, I've made it in life. And like more of like a shiny, flashy type approach. And that's, like, as you guys probably noticed, that's not really my mentality. So for me, it was about just demonstrating value on an as small basis as possible. Like, if a guy can invest 5K, we'll demonstrate value on that. And we have a Reg A platform that enables people to invest. And it's a Reg A, so I can talk about performance. Like last year, people made 17% in that fund, right? Then we have other strategies where it's more of like a debt fund. We have other strategies that are syndications that are more tax efficient. So we have a strategy for everybody, wherever they are. But fundamentally, a lot of times when you get in a call with a new investor, it's, hey, like, what's the minimum I can invest?
Yep.
So for them, they're looking to establish, can I Mustafa deliver, or can Deep Blue Capital, can they deliver? They're looking to build out the relationship and wondering, how much do I have to risk? So for me on WhatsApp, it was a similar mentality, right? Because I'm working that W-2 job. I'm building out and trying to build out a strategy that works for the average working American who's hardworking. They're looking for a solid place to invest their capital. They're looking for somebody who's responsive and who's, willing and able to take out the time to explain a strategy to them. And they're looking for a long-term partnership, and they're looking to grow over time. So that was really the premise, like understanding the psychology of an individual and extrapolating to say, hey, where do these people hang out, so to speak? And how can you make it so that you're positioned to be accessible, but you're also not annoying? Like, it's great when you get like a Google ad that targets exactly what you're looking for, but it's annoying when you see so many ads that are irrelevant.
Right.
That's kind of my mentality. Like, I don't like to necessarily be pitched things, but I like to invest in the things that I want to see. So that's my approach a lot of times, is just to be accessible, but not necessarily sending, a newsletter, email every week or every month, or it's more people tell me what they're looking for, and I reach out to them when I have the right strategy that aligns with their goals.
Sure.
So to answer your question on WhatsApp, it's basically about positioning, in the sense that you would go to, like, maybe you'd go to the bar to meet girls, or you'd go to, an investor summit to learn about investing and investor opportunities and coaching and mentorship. Or, if you're a capital raiser, maybe your strategy would be to go to, continued education courses to target dentists, doctors, etc. So for me, it was, hey, listen, I heard through the grapevine that there's this networking group on WhatsApp that has a lot of people looking for investments. Fine. Like, it's a very financial literacy based type group. Let me join the group. Then I spent about a year seeing the different investment options that were being provided, let's say 6 months to a year. So just doing your market research, let's call it, just to be prepared for that one shot that I have, so to speak. Along the way, I see, like, who do I know in this group who has, authority? Like, people trust them. And how can we leverage that authority as, hey, I know Mustafa. Mustafa's a nice guy. You can trust him, etc. And I'm also investing with Mustafa. So that's really how I built out the whole conversation, to say, hey, it's not just Mustafa, some individual who's working in the pharmaceutical industry and who's, 25 years old, raising money. It's, hey, Mustafa, and he passes these different, social proof, so to speak. This is like, I'm coming from like a science background, right? So I'm not coming from a marketing, capital raising, real estate type background. But these are just things that make sense to me, so to speak. Like, you want to work with people who you trust. How does an individual establish trust? You want to have conversations with people who have capital. How do you find where people hang out that have capital and that are looking to invest? So a lot of it is like, psychology, positioning, things of that nature. But fundamentally, if you don't have a good product, it's a bit irrelevant, right? I know earlier we talked about underwriting and things of that nature. It's very important to talk to people who you can understand how they think. And it's very important to have products that people can take seriously. And in real estate, I think if you can structure a product with a shorter time frame, it's nice as a proof of concept. It's not always possible, because a normal syndication will be like a 5 to 7 year hold.
Mhm.
So if you have, an income or debt fund that's paying people monthly, then that's a nice option. It's a short-term debt note, collateralized, non-collateralized, depending on the structure. It's a nice vehicle to have. If you have something that's, an equity fund that with like a 2-year minimum, with like monthly statements from a fund admin, it's nice, because that's like gone through all the compliance required. It's listed on the SEC website. It checks a lot of boxes for investors to say, hey, I randomly met this person on WhatsApp, or I randomly listened to this person on a podcast, or I randomly met them on LinkedIn, and they're telling me to invest. Like, how do I find out that they're legitimate? And I think a lot of times, and maybe it's different your guys' experience, but for me, it's whether it's raising capital or investing myself, it's, hey, do I think that this person is credible? How has this person established credibility? And then, and also, does the investment thesis align with what I'm looking for? Does that kind of make sense, guys? And then once you get all of that right, it just kind of scales. That guy who invested 10K, he'll feel comfortable. He'll scale to 50K. He'll have a liquidity event. He'll invest, 1.7 million. Then he'll go from 50K to 1.7. And hey, you'll realize the guy lived 10 minutes away from you and you never met him. And you meet him in a foreign country. That's happened to me, where it's like, hey, I have an investor group on WhatsApp. I'm not able to meet people all the time because I have another job as well at that point in time. Then he's asking me for financial literacy advice in a foreign country. And it's the first time I'm meeting him. And he's saying, hey, I'm having a liquidity event. What do you recommend I do? And it's a conversation around him and his goals, not around me and my deals and how do I make money. And I think from a capital raising perspective, I think that's important, because if you can just talk to the person in front of you and understand their needs, then you can give them advice, because investing in real estate is not always the answer. And it's important to be honest about that, if that makes sense.
It absolutely does. And I do want to circle back to that, because just having those investor conversations and it's such a valuable skill set to be able to have those conversations well, and to truly be able to come from contribution in those conversations. But first, I want to just kind of go back to the structure of basically that MVP, minimum viable product, right? Very lean startup. You had an idea for a platform that was going to cost $500,000, right? And you took a concept and then whittled it down to essentially a mechanism on WhatsApp that created a cadence for you to be introduced to people that could be potential investors that you wouldn't have otherwise known. That is a great example of just continuing to move forward without things having to be perfect in your world or in your business. I think one of the things that stops people from getting to where they want to go is they won't really take massive action until they feel like everything is right, until they feel like they have, the maximum viable product rather than the minimum. And so if you could kind of just speak to any advice you could give to operators or people, just entrepreneurs in general, around going from $500,000 cash outlay to build something to just like, I'm just going to shoot messages off on WhatsApp, is a pretty radical shift in ideology, but you made it work. So what sort of, advice would you give to those people that feel like they're not able to get over the hump because things aren't really perfect yet?
So I guess to first answer your question, I think the answer is different depending on who you're talking to. You specified entrepreneurs. So like the W-2 employee and his mindset is completely different. The entrepreneur is used to taking risk. And the question is, like, because the entrepreneur is used to taking risk, it kind of comes down to, hey, listen, how do you position yourself so that you will be successful eventually, versus just like analysis paralysis or negative, oh, I can't do this because of this issue. Like if you need $500,000 to build out your vision and you don't have $500,000, how do you still build out your vision? You're young, in theory, you're hungry. So go to work, figure out how to like move forward, take that one step at a time and say, how do I position myself from the capital raising perspective? I have deal flow that I think is amazing. How do I position myself to raise capital? And that's really, really how I would address the question, to say, like, just take a deep breath. What you wanted to do isn't working out. It's fine to pivot. It's not the end of the world. You'll get there eventually. You just need a couple steps in the right direction, and then you'll figure out what's genuine to you, and you'll connect with investors who have similar preferences and personality types, etc., and they'll have money and life will be okay from a capital raising perspective, right? From a development perspective or all the underwriting, etc., I think it's really just comes down to understanding yourself. If you understand yourself and you do things that you like to do, you'll build your tribe. And you see this a lot on social media and a lot in different aspects that we talk about, like the importance of a tribe and the importance of having people who know, like, and trust you or think similar to you. It's really important because it's very easy to have a solopreneur mindset of, hey, it's just me and I'm going to do everything. And it's fine. You can do everything. If you're listening to this podcast, you are amazing. You can do it. But what if you could accomplish the same 10 years worth of growth in 1 year? What would that look like? And what would your next 10 years look like if you scaled that aggressively every year? And I think to some degree, that's the important mindset, to say, hey, listen, how do I continue to scale aggressively despite X, Y, and Z issues that are happening, right? Like before this podcast went live, we talked about cars being stolen. I mentioned 2 of my cars were stolen.
Yeah.
No problem. Life goes on. Like I can cry about my 2 cars, or I can go make more money and help people and create jobs and all these other things that are more important than my cars. And that's kind of how I approach it, because in life, there's always some setback, right? Like there's always some reason not to do the work. And if you're just positioning yourself to be comfortable being uncomfortable, if you're positioning yourself saying, hey, listen, this is the path I want to take because it's easy, and this is the path that's maybe a little bit more difficult, that little bit more difficult path is usually the right option. And then sometimes you reach a point where you're like too uncomfortable. So you have to scale back a little bit and say, hey, listen, like I'm now in uncharted territory. I'm burning 100K a month in, I don't know, marketing ad spend, and I'm not raising any capital. Time to scale back.
Yep.
Or I'm spending all of my time networking with developers and my family life is bad. Time to scale back. Because there's more to life than work, and it's important to kind of have a holistic approach. And that's coming from a workaholic who recognizes that I need to improve in that specific space as well.
Awareness is the first step, I think, for all of us, right? I really love that mindset. I've heard this before, and I don't remember where I first heard it, but measuring momentum rather than measuring that ultimate outcome that you're chasing. Because if you're just living and dying off that thing that you're trying to accomplish in the future, your time horizon is going to eat you up, because it's not going to happen overnight. But if you ask yourself and you do a little bit of self-discovery on a regular basis and ask yourself where you were as compared to where you are now, it continues to help propel you forward. Measure momentum. That's how you succeed over the long term. Things don't happen overnight.
Yeah. So Mustafa, let's I definitely want to give, I think you have a very unique niche in the real estate market that we haven't really talked about on the show before. So you mentioned before that you do a lot of development and some value add within 45 minutes in New York City. So, a lot to unpack there, but give our audience a little bit more depth and detail on that, if you don't mind.
Sure. So I'm happy you guys talked about it, because the name of the podcast is More Doors Podcast.
That's right.
In development, it's important, but it's not necessarily the measurement that we go by. Like a lot, like, if you've read, like, some books will talk about, hey, start with one door and then scale from there. We don't really, in development, at least when I look at it, I don't really look at the doors. I don't really look at AUM, on a micro level. And so in development, a lot of times it's, hey, what is the potential value you can create here? You can buy this vacant land, you can develop it, you can refi all your money out, and then you can hold that long term. So imagine you're a burr, but like with land.
Right.
And instead of having, a single family house that's a single family house at the end of the process, worth more, you have raw land, which is not monetized, it's not income producing, to a 6-unit apartment complex that is income producing.
Yep.
Obviously, like in real estate, a lot of times, we're told or we communicate that you buy other people's problems. If you buy something that's not making money and you turn it into something with multiple revenue streams, let's call it like 6 people paying, it's obviously worth more. And so that's really what we do at a micro level. We go in and we find opportunities where we can rezone and develop. We're in an opportunity zone in a state that has, quote unquote, high taxes. So the opportunity zone enables us to have tax abatements on these assets. So now you have a 20, 30-year tax abatement where the taxes on the property are only based on the value of the land. So instead of buying vacant land, let's say you bought a $500,000 house, taxes were probably 10 to 14K a year. You rezone that land that took, let's say, 6 months. You demolish the house. Now the taxes dropped from, let's call it 10 to 14K to $1,000. Now you build a $7 million apartment complex on it, and the taxes are still $1,000. So now you have a $7 million asset. You didn't spend $7 million to build it. It's appraising at $7 million. It's cash flowing, and you're paying $1,000 in taxes for the next 10 years, with increasing taxes the next 20 years after, until you get to full taxation. So I think, from a More Doors podcast perspective, from a listener perspective, it's just about finding alternative ways to add more value, finding alternative ways to generate more cash flow. And one of them is tax abatements. One of them is in opportunity zones, because ultimately you're adding value in an area where the government wants you to add value.
Yeah.
So if the government is now your partner, it's nice. It's a good position. It's a good way to position yourself, if that makes sense.
Yeah. So just help our audience drill into this a little bit. So how do you identify opportunity zones in your investing area?
Yeah, so it's something that you can go on like the government websites. You could even Google opportunity zones in the United States or opportunity zones. I think you guys are based in Texas or no? Sorry.
Yeah, North Texas.
Yeah.
North Texas, right? So you could go to opportunity zones in Texas or opportunity zones in the Sun Belt, whatever region you're looking at, opportunity zones in New Jersey and New York. And it'll come up with, different areas that are zoned as opportunity zones. And then accordingly, you can look, like what we do is we look at areas that are pro development. So they're pro rezoning. And then accordingly, we'll buy land, we'll buy houses, etc. in those markets, in those areas where the city, the state, the government, they're all pro rezoning and pro development, because those areas have historically been under invested in. Like in our market, the average inventory is from 1955 with over 70% pre 1940s. So you have very old inventory. So we're going in, we're buying that inventory, we're rezoning, demolishing, developing, refinancing. At that point, our investors who started with us at the beginning of the process, they made all their money back in a 2-year period plus profit, and they own equity in the asset. Like that's a specific strategy more for tax efficiency and stuff like that, because when you're refining, you're not paying any taxes on that money. So at a basic level, it just comes down to research, understanding the niche you want to be in. Nationwide, there's a housing shortage. So, if your thesis is a lot of people are going into multifamily value add in the Sun Belt, that means there's money there. You can do that. If your thesis is, hey, a lot of people are looking left, I'm going to look right. There'll be less competition, and I live to the right, so I'll have more geographic expertise in this region. Then that's also a viable strategy, and that's kind of how we approach our strategy, if that makes sense.
Totally. Sounds like kind of a red ocean, blue ocean move for the oceanographers in the room. So I'm sorry. This is like a topic I'm super passionate about, right? I have an inbox of like 150,000 unread emails all about deals. And I can't tell you how many I get that are land deals that says, zoned commercial, but if you rezone to multifamily and build 32 units, you have a $18 million ARV or something.
It's a 50 cap.
Exactly.
If you do it this way.
Exactly. The legalities around rezoning scare the shit out of me, right? So how have you guys approached that so that you're mitigating your risk, you're investing in land, you're buying the land with the intent to rezone, and that you're successful getting that rezoning? Because without that, there is no project, right? You have to get the rezoning pushed through in order to build. So how has that
Correct.
been for you guys, and what's your process?
Correct. I think it's a great question. So first of all, I want to apologize to you for the state of your inbox. I'm in a similar situation, and it's very, I don't think it's overwhelming. It's just annoying because I view myself as a very efficient person. So it's very annoying because it's a measure of, I guess, inefficiency. Or
Well, when I leave here, I'm going on inbox 0, so I'll see you in about 3 weeks.
There you go.
Okay, beautiful. So that's number one. Number two, I was concerned you were going to ask me about whales.
That's Brian's job.
Number three, this charts into that territory if you don't know what you don't know. I'm very pro learning about different things, and I'm happy you asked the question. And I would also add that I'm not an expert in rezoning, although we do it as a firm, right? So with all of that said, like looking at deals outside of your normal bread and butter is good, healthy. It's a good area to learn. But I wouldn't necessarily, especially in the position we're in, I wouldn't necessarily invest in those deals because of the things that you mentioned. Our firm, we've done over 400 rezonings with a 99% success rate. That means 4 didn't work out. Now, in those situations, did investors lose money? No. In a lot of situations, historically, we would invest our own capital and then syndicate after it's rezoned so that investors don't take on that risk of rezoning. Because what can happen in rezoning, it's, to your point, it's not a small risk at all, right? You're buying this land and you're advertised something. Now, in the real estate space, I'm of the mindset that what you're being advertised is not really the case. The pro forma isn't always correctly done. Sometimes things look a certain way and there's a certain narrative behind it. And we just have to kind of ask the right questions to get a more full picture. And that's the situation with the pro formas that you kind of alluded to. It's zoned commercial. You have to rezone to residential. And correct me if I'm remembering anything incorrectly, but that process could take 3 months. It could take 3 years and not happen. It just depends on the area and are they pro rezoning. And then the caveat is they could be pro rezoning, and then in the middle of your rezoning application, maybe a slaughterhouse is approved right next to your property.
Mm.
Now you can't have your residential multifamily apartment complex right next to a slaughterhouse. It's probably not going to be approved. And that was a situation that happened to us once. It's like, okay, hey, no problem. There's a slaughterhouse now. We can rezone it to like cold storage or something, and we can still make money. And I think to some degree, with real estate investments, it's important to kind of be able to pivot and understand the value of the asset before you pull the trigger, right? If you're buying well, which is typically a common theme in real estate, when you're buying well, you're insulated. But we're not in the position of just buying land to then sell land a year later because the rezoning didn't work out, right? Even if our investors make money, yeah, we're happy. Or even if in that case we deployed our own, like we self-funded the entire deal and we made a little bit of money, sure, we're happy to some extent. But it's kind of about understanding the risk profile, the market, who is currently rezoning, what is the city's view on rezoning. And I think the view in Texas, where there's a lot of land, is probably very different than the view in New Jersey, where there's less land. New Jersey is the most densely populated state in the country. So there's not that much land. There's a lot of people per square foot. So it's going to be a situation where for them, because of the way the national housing is and the shortage there, they need housing solutions. And that's kind of why, the positioning is important. I hope I answered your question in enough depth, but please, tell me if you have any follow-ups on this.
No, I think you did. So I guess for someone wanting to take the leap into a project like this, are there attorneys that specialize in these types of things? Is it as simple as reaching out to one of them and kind of vet the project? Or are there teams? Do you need development, architects and development plans and stuff? If you can just kind of hit on that, that'd be great.
Sure, more than happy to. So it really depends on the deal, right? So for example, I have, some of my investors have invested in a land deal in Texas. And it was one of those things that it was a lock, slam dunk, 30% IRR type deal. And, my reaction to this is, hey, like, go for it if you want. It's not something that I recommend because I don't know the party. And then a couple of years later, I've gotten to know the party and that deal didn't work out as advertised. By no fault of the operator, just because, sometimes land deals are difficult. So this deal was that they were rezoning land. They had, it in contract with like an anchor store to then it was becoming a commercial strip. And, the anchor store was going to basically lease out everything and it was going to work out well for them. And then their lead, basically the person they're going to sell to, they backed out. So you had land, you rezoned it, and then the person you had envisioned selling it to backed out. It's not an ideal situation, right? So it's one of those things that there are attorneys that can help with this. I mean, even if you reached out to me, I'm sure I could find the right person that services that market to help out. But it's one of those things that fundamentally you want to understand the strategy. Is the person you're investing with, the person that's syndicating, the person that's reached out to you, the broker, the listing agent, whomever it is, what is their experience in this space? I wouldn't necessarily go with somebody who's never done deals like this. I would go for, especially if you want to be a passive investor, I would go for a syndication firm that only does land rezoning or land banking or investing in land in the area that you're in. And the reason why I would go so hyper specific and really find the best person rezoning land in North Texas, for example, is because that's all they do. And because that's all they do, they're very good at it. And then the first question I would ask them is like, why is this all you do? Everyone else is talking about diversification. Everyone else is talking about investing in multiple markets. Why are you limiting yourself to North Texas? And it's a question designed to put them on the defensive. And the correct answer from my perspective is we stay in our lane. We invest only in North Texas because that's what we're very good at. And we're in a position to find you the best deal, the best land deals in North Texas to make you the most amount of money, because you can invest with somebody else. And I'm sure they'll do great as well. But we've been in this market for 20 plus years or whatever their metrics are. We've done over 100 rezonings or 100 land deals. And this is our track record in this one area. So that's what we're very good at. And that's how I would approach it. I would try to find the best person for the strategy you're looking for, whether it's, ground up construction, land banking, or, swimming on dolphins and
Orcas.
I apologize. My memory is not that good.
And by the way, for those not paying attention, Brian is our in-house orca swimming expert.
100%. I appreciate the depth of all the answers because it's super valuable. And kind of getting back to basic principles as well. You alluded to this before. Part of mitigating your downside is getting a deal, buying deep. So if the rezoning doesn't work out, or if you have to zone to a different type of asset like cold storage or something, you already know that you're buying the land at a price that if nothing else goes as planned, you're insulated in the manner because you got the asset at a discount. And I think that's a really important part of the puzzle that not everybody always focuses on with the intent that they should.
Yeah, and just to build on it, it's one of those things that we're talking about land rezoning and things of that nature. It's quote unquote a high risk strategy. I'm in development. It's quote unquote a high risk strategy when you talk to people normally. So when I'm talking to people and I'm trying to understand, like we're having the conversation, why real estate? They're overexposed in the stock market, and we're saying, hey, is that a problem? It's up to them. It's their portfolio. I'm just trying to act as their mirror and just kind of shed light and add value. So if they conclude, hey, I have too much in the stock market, my 401k is in the stock market, my, after tax money is in the stock market, I have XYZ brokerage accounts, etc. I want to invest in real estate, but I'm scared. And this is kind of stuff that we alluded to with like taking small steps. No problem. There's a self-directed IRA route. You can invest in real estate with your retirement money if you're comfortable with that. And the reason I start there is because that money is illiquid anyway until 65 for most people. So that's like testing us out at the most low minimum, but also the capital that doesn't impact you right now, right? Like if you lost 100K today from your savings or your checking account, it would hurt you a lot more than if you lost 100K from your retirement account. The value of that 100K in your retirement account is very important because of future growth, right? So that opportunity cost is very high. But either way, you would have the same lost earning potential no matter where you lost your 100K. It's, hey, do you want 100K loss from something illiquid that you didn't have access to, or something liquid? And that's why a lot of times there's a lot of different pieces. It's like the right strategy, the right capital source to fund the project. And it's the same, when you're looking at like construction loans and things of that nature. And ultimately like, bridge loans and long-term financing. It's just at every level of the conversation, it's just about finding the right vehicle for the right person. And when we're talking about investing in land, I wouldn't recommend it for somebody, and just a land deal, just focusing on rezoning land and then selling it. If I'm a W-2 employee, I'm busy with my 9 to 5, and I want to get started in real estate, personally, I would not recommend buying land with the purpose of holding it for 10 years and selling. I come across people who are doing that. It's a great strategy for people who want to do it. For me, my question is, are you making money over the next 10 years, or are you just paying the taxes? Is it really an asset, or is it more of a liability? What are you doing to drive value creation? And I think that's an important piece that every real estate investor needs to ask, because in most situations, just like the stock market, if you just sit on your real estate, you will probably make money. But you want to figure out how can you add value and how can you add the most value, and then invest accordingly while buying right.
Love it. Love it. So a couple of quick questions here. I want to be conscious of time. I've heard, and Brian and Nick and I have shared numerous articles over the last couple of weeks into the last few months that multifamily starts are off the cliff, right? Capital is expensive. There's very few new permits being issued or requested, etc. So as a company that specializes in, buying land, rezoning, and then building, how are you and the rest of the company navigating this part of the market cycle and still managing to be successful?
I think the reality of the situation is like nothing is done in a vacuum, right? We're in a situation where the US over the last, let's call it 3 years or so, has printed a lot of money. So that led to inflation. The US's response to inflation was to raise interest rates. And now inflation is dropping to that targeted 2 to 3% type number. So now when you raise interest rates, that impacts a lot of different industries. One of them is real estate. So we're in a situation where construction is expensive, right? And you're using leverage, you're using construction loans, things of that nature. So when interest rates go up, it gets more expensive. But if you're in a position where you have the right team, your construction on a per square foot basis is low, then you're able to absorb market dynamics more readily. And that's the situation for us, right? We have a strong team. Our construction costs are quite competitive. So we keep our costs low, and we've done that historically. And that's enabled us to weather financing becoming more expensive. That's piece number one, just our expertise and our ability to build costs low. Point number two is what's happened to rent over the last 3 to 5 years. It's gone up a lot, especially across the country, but in New Jersey, New York, and our areas, it's gone up a lot as well. And I think that's an important piece because it speaks to income, right? If your expenses for building are higher and your income is much higher, then that spread actually ended up increasing. That's piece number two in terms of just ARVs, after repair values, after construction. The assets are worth much more than we originally projected. Right now, we're mid-construction on a 138-unit building. We're mid-construction on a 188-unit building. The 138-unit building we were building through COVID with all the different supply chain issues, right? And it's a situation where it'll appraise for much more than we originally projected because rent went up so much. So that's the situation that we're in, where income is projected to be much higher than it was originally underwritten for. And that's like a quote unquote freak type situation where you can't bank on that. When you're underwriting, you can't assume a 30% type increase in rent. But if the US's fiscal policy is that inflation happened, you as the investor were investing in real estate to hedge against inflation. Inflation happened. Real estate became more expensive, more valuable, etc. That means it served the fundamental purpose of why you invested in real estate. Now, you happen to be in a ground-up construction project. So that inflated cost of living also impacted rent prices. So rent went up a lot. Now you're in a situation where you're making money, you're projected to make money, etc. And you're kind of protected from these pieces. But that doesn't mean that tomorrow when you're refinancing out, you could still have debt service coverage constraints. So at that point, maybe your asset is worth much more than you projected. You cashed out similar level you expected. So maybe you have more equity stuck in the deal. It just depends on how each individual deal plays out. But those are the three, at a very cursory answer, those are the three things that I would look at.
Love that.
That's been so in depth, man. A lot of really, really great nuggets there. Like I said, we want to be respectful of time and want to kind of start to, as we wind down here, couple of things. First, we always ask for just what's the best kind of general advice that you would give for somebody that is really looking to get just becoming an operator themselves. Maybe they've invested passively or not invested at all, but they really want to get into the operator side. What's maybe the best general advice you have for them? And then on top of that, where can people find you? Where can they connect with you? And give us the place where people can find you.
No, I love it. In terms of general advice, I think what I would say is understand your why. And it might be boring or overstated, but if your why, hey, I want to become an operator. Why? To make more money? It might not be the most efficient path. It might not be. Yeah. And okay, fine. If your why is to make more money, then position yourself with that one operator that is making you the most money because you're an LP. So being an LP is a good way to get deal flow, and then work with the GP that you like. You like their personality, you like their deals, etc. So then you ask them, hey, listen, I'm investing in a lot of your deals. How can I add value to you? And they're going to say, oh, no, I'm fine. Can I create a fund of funds? They'll say yes. Can you help me create a fund of funds? They'll probably say no, because no one has free time. That's when you reach out to me and I'll show you how to do it, or I'll connect you with somebody who can do it, who can help you do it. But it's really just about, knowing who to talk to. And you only know who to talk to by taking those couple steps, by taking action, by starting to invest, by entering that space. And then as you get more comfortable, you take more risks of having those conversations, which can be uncomfortable. But worst case scenario, somebody's going to tell you, sorry, I can't help. And that's why you have podcasts like More Doors Podcast, because you can reach out to any of these guys and I'm sure they'll be happy to help.
Absolutely, brother. We always will. It's fantastic advice.
So yeah, in terms of how you can reach me, probably email is a good way. LinkedIn is a good way. It's ml@velocecapital.com. LinkedIn, it's Mustafa Ladha. The name will be in the show notes, I'm sure.
Yeah, absolutely, man. We'll make sure to post the email, website, and all that type of stuff as well. Final thoughts, boys, before we sign off.
I think this was awesome. Yeah. Definitely a niche we haven't had on the show yet. We don't get a whole lot of folks from Jersey on the show. I'm originally from New York, so I can do that and not get arrested for it. Mustafa, off-topic question: when you pull over on the New Jersey Turnpike to get gas, do they still insist on pumping the gas for you? Or
Yeah, I'm too impatient. I pump it myself. I'm from North Jersey. We're a bit hustler like that.
Nice. New Jersey Drive, right? I heard that that's a real thing.
It gets worse. The more South Jersey you get, oh man, it's bad. Then I understand the stereotypes.
Awesome. Mustafa, this has been great. Everybody who's listening, go check out Mustafa on social. He's super active on LinkedIn. That's actually how we got connected. Go check out deepbluere.com. Sign up for the newsletter. Download the ebook. I'm going to correct my friend Nick. It did not take Brian years to write that book. It took Brian years to spell check the book. He's actually very quick at writing. It's the spelling that's a problem.
Admittedly.
And then after you go to Deep Blue RE, go to our YouTube channel, hit subscribe, give us some feedback, give us some 5-star reviews, and go check out our boy Jesse, the Wizard of Oz, Showalter. Send him some beard butter, and he'll get you a good discount on getting your own podcast out there.
Only if it's homemade beard butter.
Yeah, right.
Yeah.
Is there such a thing?
Jesse makes his own.
Really?
Yeah.
I don't know. I don't want to ask any more questions about that.
That's a different podcast.
That's it. Mustafa, thanks so much for joining us. Thanks, everybody. We'll see you next week with episode 50.
Boom.
Oof.
Thanks, guys. I appreciate it. Have a good one.
Thanks,
You too,
brother.
brother.